Hey there, investors. Todd here, founder of Inside Edge Capital, founder of TradingAnalysis.com, and hope this finds you well. It is now Monday night, May 22nd, and I'd like to take you through some updates that we've made here on the portfolio side at Inside Edge Capital. Update you on the business, update you on the way we see the economy and the markets unfolding, and certainly no shortage of excitement, which is kind of status quo in this kind of environment here. So lots to talk about. We've made a full rebalance and reallocation in the middle part of last week. And then we executed, I believe it was Wednesday, the 17th. And then you would have seen the trades and allocations come into your accounts on Thursday and Friday. Okay, so we'll take you through everything we've done in the portfolios and the sector level, and then we'll jump down and show you each individual stock in terms of what we've done, whether you're in the dividend or growth portfolio or some mix, and take it from there. But again, all's well here. We're continuing to build up the new website, Inside Edge Capital, and you'll see that here shortly. But it's business as usual, and our full attention is on my side on the markets and in Kyle's side, financial planning with all of our clients. So we are firing on all cylinders. So if there's anything we can do for you, please let us know. But without further ado, let's jump in, and I'll show you what, at least the way we see markets unfolding here. Okay, so let's jump in. Disclosures, have a look. If you have any questions there, disclosures there for you. So the starting gate. So the three main topics we're going to cover here today are going to be inflation and debt ceiling. So we have a pending June 1 limit, which is a final deadline for Washington to come to an agreement with the debt ceiling. So originally, debt ceiling, I have some stats in here, was first set in 1936, and I believe this will be the 83rd time that they're going to raise the debt ceiling. So interesting. Inflation, of course, is the big thing that's driving the increase in interest rates, which has caused so much volatility. And then we'll go into recession. Are we in recession? We'll look at Q1 earnings that we've just completed. We'll look at the big regional bank boom. Are we in the next global financial crisis? And then we'll take a look at the major growth trade rotation. And finally, we'll look at portfolio updates that we've done, as I said, just last week. And there was multiple weeks building up to the actual execution and reallocation and restructuring of the portfolio. So number one, let's hit in. Let's start inflation and debt ceiling. Is inflation cooling? The short answer is yes. We've just most recently seen in the April CPI a headline reading of a 4%, and we'll jump into the details of the report. And the debt ceiling, I believe President Biden and Speaker McCarthy met this evening at about 5:30. I'm recording this at about 10 o'clock at night, late Monday night. And the details are trickling out. Futures are up here a little bit, and I'm relatively certain that the politicians will come together, play nice, and agree to raise the debt ceiling because, as it is now, U.S. Treasuries are already in a precarious position as Treasuries are selling off, interest rates are spiking for, as we mentioned, inflation and other reasons, and they really don't need another reason to send bond prices down, interest rates up, because the amount of money it costs to service the debt with the increasing interest rates is certainly calling the Fed's ability and the Treasury's ability to service that debt, calling it into question. So let's first take a look at CPI. So this is going to be the 12-month percent change CPI. You had a high up around 8.1, somewhere in the 8 handle was the high reading. Actually, no, it might even hit a 9 handle. But we have come off. The most recent reading here, April of 23, was a 4.9% drop. So here was the big spike in post-COVID. up to, let's call it 9%. We're down around 4.9%, so pretty good drop. Year-over-year inflation dropped sub 5 for the first time since May of 21, right here. We'll jump into the actual CPI report, but the expected increases, there were increases in expected components of CPI, which are shelter, housing, food, and energy. Okay, food was noticeably strong in the away from home category. Consumers are eating out, which is interesting because one of the themes that we're seeing is a strong consumer. We are seeing strength in some very interesting areas of consumer discretionary. Most notable are restaurants, hotels, casinos, gambling, home builders. We're seeing some very interesting strength in certain industries within the consumer discretionary sector that suggests that no, we're not in a recession. In fact, consumers are out spending, which that's a good thing. But again, we have pressures on CPI and price that we'd like to see cool to come down. But again, there's signs that the economy is quite strong by looking at the performance of certain industry groups within consumer discretionary. And again, we'll talk about that. Okay, so here's actually the gory details of the last CPI report. And there's a couple serious points, one not so serious points, just try to get a chuckle out of you. Food is a big one. And food right here constitutes, I'm sorry for the small font, 13.47% of the headline CPI report. And what we saw here, food at home, okay, was actually negative. I know it's real small, but it says negative 0.2. So food at home was down, but food at home was down, but food away from home was actually up 0.2. So again, that's people going out. And what I found interesting within the food category is cereals and bakery products were up 0.2%, but meat, poultry, fish, and eggs were down negative 0.3%. So how do we, get food component of the CPI to come down? Well, I would say eat at home more and eat more protein, less carbs. But all in all, the food category of this most recent report was 0. So altogether it was a 0.0. And again, food away from home not being so strong, you might have seen a negative print on food, which is good. Energy right here, energy was up 0.6. And again, that's good. You saw a bounce in crude oil prices. You're seeing it in gasoline. You're seeing it in natural gas. And that's good because crude oil is not trading based on future inflation. Right now, crude oil or even geopolitical pressures, crude oil right now is trading based on the outlook for future demand or lack of demand. And in fact, if we are going into recession, crude oil was starting to price that in, that we are going to recession. That would equate to lesser demand. So crude oil was dropping, but all of a sudden crude oil found a good technical base and then started to move up, which again, that is starting to price out the chance of recession and good demand as we are now in summer driving season. So I do want to see energy stay strong. I don't want to see too much of a drop in energy because again, that's an outlook for lesser demand. Okay. Another sticky part of CPI right here is used car prices. So it's only 2.57% of the reading, but it was up 4.4%. So used cars were very sticky. And another component, which is 34%, which is shelter, which I don't think we're going to see any easing on upward pricing pressure because I believe the housing market is very strong. We actually added some home builders to the portfolio with shelter. So shelter was up 0.4%. And there's a lot of debate as to what facts and figures and the nature of the lagging data that the Fed's using to measure real estate. But, the main drivers, again, were cars. New vehicles are actually down. It's more specifically used cars. Shelter up 4%. Used cars up 4.4%. Food was even. And then energy was up 0.6. Okay, so a few of the things, as I said, food, services, people going out, people are spending, people are driving, people are traveling. Those components, those parts of the CPI, I don't think are going to come off. So is that a bad thing? I don't think so. Now, if we talk about the Fed is most likely set to cease raising interest rates in the June meeting. We have about a 75% chance, as I record tonight, of no additional rate increases. The market is starting to put on about a 20 to 30% chance in coming meetings of another 25 basis points. So currently the target range of the Fed funds rate is 5.00 to 5.25. And right now there's about a 30% chance that they're going to do another 25 basis points, which is 0.25%. But that can come out. This Fed fund futures market trades just like Tesla stock. I mean, it's all day, it's moving back and forth. So that could be priced out tomorrow. So we are seeing an upward push on interest rates, which is a little consuming on the long end of the curve. And I think it reflects this, which are the politicians in Washington playing political chicken here. So I do think there's some selling of U.S. Treasuries right now, which are pushing yields up. The 10-year yield, which is really the key interest rate that drives and sets interest rates, and much of the American economy has been pushing up against 3.75%, which is technical resistance that we follow daily on my research business, TradingAnalysis.com. We don't want to see that 10-year yield move up anymore. And again, that's that 10-year yield sets 30-year mortgage rates. It sets borrowing rates for credit cards and auto loans. And it's really the key benchmark interest rate that drives the American economy. So I think there's a lot of selling right now of treasuries because of the debt ceiling. So I think it's nothing more than a game of political chicken. Some fun facts and trivia for you. The debt ceiling first set back in 1936. It was raised 3 years later, 82 times after that, and this will be the 83rd. 1995, the Treasury Secretary did cancel. There was a debt ceiling event here, canceled security auctions and did borrow from retirement funds. Then again in 2011, U.S. debt was downgraded from AAA to AA plus after debt ceiling was raised. But we really haven't defaulted yet. And I don't think in this sort of sticky political and transitional economic point that I think they're trying to obviously push their own agendas and take their stance on where the federal government should be with spending and do what they can. But ultimately, I do believe that they're going to come together. Okay, so from there, are we in recession? Let's transition here, and this is, I think, more important once we get past the political theater of this debt ceiling. Are we in recession? I think the answer is no. Few reasons we'll look at: Q1 earnings, regional banks, and growth trade rotation. So this is a excerpt from FactSet, which is a great free website. You can go right to www.factset.com and read this. This is really the go-to in terms of behind the scenes about how earnings have gone. Free information. I really invite you to check it out. This was written on May 12th, so 10 days ago. To date, 92% of the companies in the S&P recorded Q1. Of these companies, 78% have reported EPS or earnings per share above the estimate for earnings per share, which is above the 10-year average of 73. It's also the highest percentage of S&P companies reporting a positive EPS surprise since Q3 of 21. In aggregate, earnings have exceeded estimates by 6.5%, which is above the 10-year average of 6.4. It's also the highest surprise percent reported by S&P companies since Q4 of 21. So basically what's happening here is many CEOs were either, whether they believed it, that they were cautioning and warning on their quarterly conference calls of coming recession, reduced demand, maybe spillover supply chain issues, and they were cautioning going forward how their next quarter reports would do, and the analysts took that and reduced the estimates based on what CEOs were saying. Well, everyone was doing it. Everyone was getting a sort of a pass to say, basically under promise, and what they're doing now is over delivering, right? So there was pretty significantly reduced expectations. A lot of CEOs were kind of, again, talking down coming quarters. Expectations were low, and as FactSet says here, 78% of the companies have beat the estimates, and that's good. Now, there was a tweet from Carl Quintanilla from CNBC, from Goldman, year over year S&P 500 earnings. So the gray dot here is expected earnings growth, and the histogram here is the analyst's bottom-up consensus. So what happened here is in Q1 of 21, this was the expected earnings. We did better than the expected earnings, and then you could see the gray. Oops, let me go back. The gray dot, again, is where we expect to see year-over-year growth. So what it's showing here is in Q1 of 23, Q2 of 23, we're negative. The trajectory has certainly been negative, but then it starts to turn back up. And they're saying as soon as 3Q of this year, we could see a return to growth compared to the prior year. So this is looking at Q1 of 23 versus Q1 of 22, and obviously quarter over quarter, so each quarter is compared to that same quarter of the prior year. So basically Q1 of 23 earnings were nowhere near as bad as analysts had expected, as cautioned by CEOs. But again, everyone was getting a pass because of inflation pressures, geopolitical wartime tension, supply chain issues, China, in a COVID lockdown period, then opening back up. Chinese demand was a major part. So all the CEOs were warning lower, and now they seem to be pleasantly surprised. So negative revisions to expected earnings the coming quarter have stopped declining. So again, the negative revisions in terms of what analysts expect going forward, those have decreased, and they're actually starting to move back up. Now, this is an actual look at earnings from the S&P 500. So what you're looking at here in blue is the S&P 500 price, 41.93 when I captured this. The orange is the actual S&P 500 EPS. So you take the 500 companies in the S&P, you add up all of their earnings per share. Some lost money, some made money. You add it all up. So, Apple's making, call it $3, $4, $5 a share. Other companies are making 50 cents a share. Other companies are losing 50 cents a share. You add it all up, and basically what you're doing each quarter, the S&P aggregate 500 stocks make about $45 to $50 a share. That's earnings of the 500 companies. Analysts get together and they come up with consensus expectation of how much they expect the markets, how much they expect the 500 companies to make in coming quarters. And you can see that in purple, this is projected out into 2023, into 2024. So the EPS expectation is actually set to break out to new highs above 2022 in early 2024. So we're halfway through 23 pretty much. 6 months from now, we are looking at making $45, $50, $55, $60 per quarter. So what they're doing is they're trying to figure out in 2023 of the 4 quarters that make up the year, where's the S&P 500 going to be? I saw figures as low as $200 over the 4 quarters. So that's $50 per quarter times 4 quarters, $200. And what's happened is we're starting to see analysts up that expectation to 200, 205. I've seen 210, 220. And again, if we get back up to 50, 55, 60, $60 per quarter times 4 is $240. And that's how you back into the multiple. You take the price of the S&P 500 trading 4,200, you divide that into how much is being made in terms of EPS, and that gives you your PE ratio if you're familiar with that. So point of this is you can see, one, the correlation between EPS, expected EPS. You can see how close expected EPS and reported EPS is between orange and purple on top of the S&P 500. So at the end of the day, what really drives stock prices are earnings. And earnings are a reflection of the macro and economic climate, which is very much driven by all the other stuff going on, including interest rates and blah, blah, blah. But it's earnings that's what drives the market longer term. Okay, so let's take a deep breath and let's talk about regional banks. So this was scary for a while, and particularly as we custody all of our money with Schwab. And I watched this very closely, and Schwab's treasury holdings were certainly a cause for concern. And basically what was happening is the regional banks who were either leveraged or had too much I would say, business commingled with risky VC, West Coast tech, crypto. Those guys, with Silicon Valley, very tech-focused lending and a lot of leverage lending. They're trying to find ways to generate return. So what they did is they took a large amount of their assets on deposit from customers and put them in short-term treasuries, tried to make a 3, 4, 5% yield, but all of a sudden yields kept going up because the Fed was raising rates, which was dropping the price of those treasuries. And all of a sudden, if customers come in and say, I want my money back, well, I can't give it back to you because it's in a losing treasury position. And you say, well, all right, well, that becomes a real problem. And, that's what happened to some of these banks. And the regional banking crisis is still going on. And now I certainly understand the cause for concern. I don't want to seem, unsympathetic to it, because regional banks are the core lending specifically for small business credit, and they're major holders of commercial real estate, which is another potential fire that's smoldering just below the surface. And I certainly do understand the great migration out of the cities and out of commercial real estate as people continue to work at home, and we just don't need to have spend on the same real estate as we did as technology has become a greater part of our lives, which is a big part of the growth rotation and a theme in this portfolio. So there are certainly some bad commercial real estate loans out there held by these banks. But I just want to put it into context and perspective, like how big these regional banks are. And again, they're the gatekeepers to credit to small business for now, and they're also the holders of a lot of commercial real estate and some segments of commercial real estate, which is big time under pressure because of those forces that were accelerated, that were happening pre-COVID, but COVID accelerated it. And there is pressure in commercial real estate. Now, it's not a blanket statement. There are some industries within real estate, commercial real estate, that are doing quite well. A lot of the health-related industrials are doing well, but there are some other areas that are not doing well. So let's just put the regional banking situation in context. Okay, a lot of people are saying this is the global financial crisis all over again. And I said, okay, hold on one second. There's a big difference between the securities that caused the 2007, 8, and 9 GFC. I traded through it on Wall Street for a hedge fund. I was trading foreign exchange through the GFC. There was a big difference between the securities that mortgage lenders were packaging and then selling up to the investment banks compared to the securities that are causing the volatility today. Today, it's short-term U.S. Treasuries that's causing the concern with regional banks. Back then, 2007, 8, and 9, it was these packaged, collateralized debt obligations, collateralized swaps. It was leveraged, phony real estate securities that are fabricated out of thin air with a lot of leverage attached to it, and they got sold up the chain, up to investment banks, and their exposure, because the leverage nature of these was many times larger than the entire market capitalization of the bank. So much different instruments back then compared to what is causing the volatility now, which is just simply the short-term, safest treasury, paper, fixed income paper in the world, which is U.S. Treasuries. Much different environment. So, okay, what do the regional banks represent? And I put some facts and figures behind it. Okay, these are all of the industries that make up the financials, okay? There's 11 sectors that make up the American economy. There's materials, consumer discretionary, financials, real estate, communication, energy, so on and so forth, okay? These are the industries that make up the financial sector, financial services. Financial services represents 12.45% of the S&P 500. Of the sectors that make up the American economy, financials are roughly 12.45%. If you add up all of these industry groups, banks, This multi-sector holding is Berkshire Hathaway, financial debt exchange, investment banks, property casualty insurance, asset management, blah, blah, blah. All of that constitutes 12.5% of the S&P 500. Regional banks right now are $341 billion in market cap, and I captured this about 2 weeks. $341 billion in market capitalization. Sounds like a lot, right? Well, it's 8.36% of the financial services sector of the American economy. So finance is 12.5% of the American economy. The regional banks are 8% of 12%. It's 8% of financials. So it's about 1% of the American economy is all of the regional banks. Okay, so if every regional bank were to be wiped off the face of the earth, the S&P 500 would lose 1% of its market capitalization. Okay, now I understand the knock-on effects with businesses, limited access to credit, and again, these guys are holders of a lot of commercial real estate, so that would be problematic. The Fed has stepped in. It's certainly not protecting equity holders, but it's certainly helping the fixed income holders, the debt holders, and it is protecting the depositors. So there has been a pretty good bank bounce in the regional banks, and that situation has stabilized. But I wanted to put it in perspective. One, they're holding U.S. Treasuries. That's the safest paper in the world. It's not 2008 where they're holding made-up, leveraged, packaged mortgage instruments that are supposed to be, double A, single A, double A quality paper, and it's actually much less, credit worthy than that. It's a much different situation. Okay, so just wanted to talk about that. And again, what I can tell you now is as of today, May 22nd, the KRE, the regional bank ETF, is stabilizing. It's holding support, and there's already some upside movement there. So that seems to be abating. Okay, let's get technical here. I don't know, that shouldn't be there. This is in fact said. This is something else. So here's the S&P 500. Okay, this is the weekly chart going all the way back to 2018. So this is when Trump was hitting China with tariffs. We had a couple interest rate increases. Trump was seemingly threatened Jay Powell with his life and job almost every day as he was raising rates. And that was an interesting volatility period here. Here's COVID, moved up. Then we went into the highs in 2022, sold off for all of 2022, and here we are now in 23, right about here. And we have just recently broken a very key high. This was the February 2nd Groundhog's Day high of 41.95 in the S&P 500. We broke above it. We traded about 4,200 in the S&P. Today we closed about 41.95, so we're still at that level. We have broken the downtrend channel from 2022. We have broken above the February high. I don't see us in a bear market right now. I see us as pushing higher. In fact, I'll put a fun target out there. I'll put a 5,000 target in there for 2023. So 800 points as a percent of 4,200 where the S&P is right now. Call it a 20-ish%. It's not a target I'm going to, stake my career on and reputation, but I do think we're going to try to make our way up towards the all-time highs in the S&P 500. So we have reduced the amount of cash in the other portfolio, and we'll talk about that in depth. Here's the NASDAQ 100 on roughly the same period. There's COVID. Here's the 21 highs. We sold off more sharply. In the NASDAQ, tech-heavy NASDAQ was more impacted by inflation. Increasing interest rates was making the higher valued, in terms of valuation, NASDAQ stocks harder to handle and harder to hold. But we have seen a very nice move back into technology and specifically large cap tech. We did break above these August of 2022 highs in the NASDAQ 100, 13,720, and we are only 16% from the all-time highs in the NASDAQ 100, which I think is quite remarkable. A few fun stocks. Okay, we mentioned there's some areas of consumer discretionary that are showing a lot of strength, and ones that I would argue would not be showing strength if, in fact, we're in or approaching recession. Churchill Downs, CHDN, is a stock we hold in the tactical dividend portfolio. We just had the Kentucky Derby. In fact, last weekend was Preakness. Then we'll be heading to the Belmont, and then it'll be, we'll have Saratoga racetrack will be open. But Churchill Downs reports record revenue ahead of the Kentucky Derby. So you look at this stock going all the way back into 2018 and 19. There's COVID. We broke above it. We had a triple top here. Churchill Downs breaks out, all-time higher in CHDN. Again, consumer discretionary gambling stock that I wouldn't see breaking to new highs if, in fact, we're moving into recession. Housing market, I find really interesting. There's some real strength happening in the home builders right now. So this is KB Homes. I jokingly call it Katie Homes, but it's KB Homes. KBH, you can look at any of the home builders, and we added a few home builders to the portfolio. And these guys were a hot button of conversation with very low valuation because interest rates are moving up. It's that 10-year yield that really drives the 30-year mortgage. U.S. Treasury rates set the mortgage. Rates have spiked. Everyone's saying we're going into a real estate crash, and home prices are collapsing. I'm not seeing it. As I showed you, that shelter number on the CPI report was strong. I think it's going to continue to be strong. I see housing prices continue to be strong, and that's a good thing. History shows that strong housing prices correlate with higher equity prices. I want to see shelter continue to be strong, even with higher interest rates, because that goes to show the strength of the consumer. There was a report, home builder sentiment pulls out of negative territory for the first time in a year. So home builder confidence actually started to boost up. You look at input costs, like lumber costs are way off. Hopefully we're getting more and more labor to show up, and guys can... and builders can, staff their team to complete job sites. But you look at any of the major home builders like Lennar and Toll Brothers and Hovnanian and NVR and Beazer, and we're looking at KB, and I'm thinking of a few others. But you look at any of those charts, and those things are breaking to new highs. So if we're going into a housing crisis because of high interest rates and too high of home prices, again, why are home building stocks breaking to new highs? That doesn't square up with me. Okay, so let's get into portfolio updates here. A couple key points here. Number one, we've reduced our treasury holdings. And the tactical dividend, we were at 11.25% tactical dividend holdings of short-term treasury ETFs. We reduced from 11.25 to 4.5. In the growth, we were at 17% cash. We went down to 4% cash. So we put some cash to work. And that corresponds with us breaking up through those technical levels that I mentioned in the S&P and the NASDAQ. So we have been underperforming the benchmarks this year. Life to date, we're still well ahead, okay? But this year, we are underperforming the S&P benchmark and NASDAQ benchmark because of our cash holdings. I was prepared, okay? I was certainly up nights wondering, cautious, are we going to be rejected from those key technical levels and move lower? I wanted to have cash on hand to go and do some hedging, buy some inverse ETFs, go into, something of a defensive posture. So I hate underperforming my benchmark indexes year to date, but I wouldn't change anything because I wanted that cash available. If we did roll over, I wanted to take a proactive defensive approach by shorting, taking in a short ETF or a couple short ETFs again to protect if we did start to head lower. So I'm fine with the underperformance life to date because the market has been very strong on the upside, and we had 11% cash and dividend and 17% cash and growth. So I wouldn't change anything. I hope you understand that. Okay. We did increase the allocation, as we went down to 4.5% cash, increased allocation to growth stocks and away from value stocks. Okay. Largest increase in allocation was to technology and communications. Okay. So here's alpha growth sector allocation. And what I've done here is laid out the sectors. Here's our allocation within each sector. Here is versus our benchmark S&P. And here's the adjustment we've made since the last portfolio adjustment, which was in February. So we increased technology by 4%. We are, compared to the S&P, we are 14.7% heavier in tech than the S&P. So blue here is the IEC Inside Edge Alpha Growth, and purple here is the S&P 500 weighting in technology, healthcare, and so on and so forth. So you can see right here where we are relative to each sector's representation within the S&P 500. So we're heavy in tech, we're light in healthcare. Even though we kicked it up, we were very light in healthcare, but healthcare is actually, some components of healthcare are starting to come on. Excuse me, so we increased healthcare. I decreased consumer discretionary a little bit. We're at 12.5%. We're still overweight. So I was significantly overweight consumer discretionary. I backed it off a little bit, pulled it back 4.25. We're at 12.5% consumer discretionary, 2% ahead of the S&P. Comms is a big move, big one. I upped it 6%. We're 5.34% ahead of the S&P. Communications is right here. So here is comms, which is our second biggest sector weighting, and again, relative to the S&P there in purple. So up comms, actually up financials just a little bit, but we're very light financials. Financials have been underperforming a lot. So we're 8% underweight financials compared to our S&P benchmark. We've increased industrial, staples, utilities not holding, a little decrease in materials, and we have dropped energy. Okay, we've been overweight energy for a long period of time, but I have dropped it. Okay, so here's tactical dividend. So this is the dividend. Increased technology by 10% in the dividend. We are currently 34.5% allocation to technology, which is 7.18% ahead of the S&P. So notable moves in here are an increase in tech, decreasing in healthcare, increase in both consumer discretionary and communications. So in the tactical dividend, we're a little bit more evenly distributed here in communications. We are market weight and comms. So we're 8% allocated to communications here in the dividend portfolio, which is just 0.2% under the S&P's allocation. Consumer discretionary, we're still heavy. You know, we're 4% above where the S&P is at a roughly 10% allocation to consumer discretionary. Industrials, we dropped a little bit. Staples, we increased. And energy, we actually kept the same. So appreciate you watching this far. Of course, you can understand I'm going to cut the video from here as we go into the individual stock holdings within each sector. Obviously, we're going to keep that reserved for our clients. We are a full-service wealth management firm. We launched originally October of 21. It's been a very slow, steady and deliberate ramp up here. I had no desire to come to market and you know, market heavily and bring in a lot of clients. We're working with our initial freshman class, taking very good care of them, moving slowly and deliberately as we ramp up. So check us out at Inside Edge Capital. We are redesigning the website. We had changed the name. We went to New Age Wealth. We are moving to the new name Inside Edge Capital, where we will stay. And, you know, so there's a lot happening on the public front, but it is business as usual on the behind the scenes. Kyle Wasson, who does all the financial planning, is working closely with customers building long-term financial plans. I'm, of course, running the portfolios. And as I said, we're going steadily. We are slowly, you know, moving into a position where we're going to go full steam ahead as we have a good, you know, coming up on 2 years under our belt. So InsideEdgeCapital.com, you can put your name and email in there if you'd like to be updated as to developments at the company and market developments such as this. So hope to work with you in the future, or hear from you at least. I'd like to know what's going on with you personally and see if we're a fit for each other. I wish you a great rest of the trading day, and we'll see you on the next video update.